So we now go to the unrealized profit, provision for unrealized profit, specifically focusing on the non-current assets, because what we looked at in the previous lecture was on the PUP inventory. But like I said at first, the principle is the same. Let's just assume that the parent company bought equipment from the subsidiary company at 100 kwacha. Let me just do a bit of scribbling. So the parent company buys equipment, buys 100 kwacha or 100 million kwacha. Okay. Yet the subsidiary, the cost of this equipment was 80. So in the books of the subsidiary, it will record a 20 as a profit. So it will record a 20 as a profit.
Yeah.
And here we're actually assuming we don't expect this equipment that has been bought by the parent company to be sold to the outside world. We don't expect that. Because this is their PPE, which they would want to use to generate or to grow revenues. Because we know by principle that your investment in property, plant, and equipment is to grow your revenue.
Yes.
This is why you're actually investing in your PPE.
Yeah.
So here we are not even talking about the outside world and all that. We know automatically that this 20 in the books, this 20 in the books of the subsidiary has been regarded as profits, but as a group, it is PUP. It is provision for realized profit, which then we need to debug. We need to remove from our group financials. Sidney, are you there?
I'm here, sir. Very much alive.
Yeah, I should be seeing you because I was thinking I'm talking to myself.
No, it's fine. It's fine.
Yeah, I should be able to see you. So we are saying in the group financials, this 20 is going to be regarded as unrealized profit. So then what we do, an increase in assets triggers a debit. So any increase in assets is debited, a decrease is credited. So we are going to credit the property, plant, and equipment. That is what we are actually going in the statement of financial position. But even when we are crediting this, all we are actually doing is to credit whoever has bought. In this case is P, the parent company. So we are going to adjust that by reducing the property, plant, and equipment, reducing it by 20 million kwacha. Then we know again that in the books of the subsidiary had recorded, they recorded that 20 as a profit. So if they recorded as a profit, it went to the balance sheet. Remember that everything that is in the income statement, it finds itself in a way, it finds itself in the balance sheet because it comes in as profits, which is added to the retained earnings brought down, which goes into the balance sheet. So here it means that that 20 will definitely adjust the retained earnings for the subsidiary.
Okay.
If it was the subsidiary buying from the parent company, it would certainly be vice versa.
Yeah.
I hope you understand this logic. You know, when you don't use sometimes you might actually end up memorizing, which becomes very toxic.
No, I'm getting the logic.
Mm-hmm. So this is how it is. This is how you should actually treat your provision for unrealized profit.
The difference with this is that you don't need to consider when it is sold outside.
No, you don't. Okay. Because whoever is buying the equipment wants to use it as principal assets for revenue generation. You get the logic, yeah?
Yes.
Mm-hmm. Very good. Mm-hmm. So this is just basic illustration. Says a parent company sold an item of property, plant, and equipment for $250,000 to its subsidiary on the last day of the reporting period, when its carrying value was 200,000 kwacha. The intra-group profit of 50,000. So here, what it is that it's the same example I was giving you. The first part where we're talking about 80 and 100. The parent company has sold to the subsidiary 250,000. Yet the carrying value was 200,000. So in short, the parent company made a profit of 50,000 kwacha. So at the time of consolidating, we'll make sure that whatever went to the subsidiary has to be reduced by 50,000. It has to go back to the 200,000. So what does it mean? It means that we're going to credit the property, plant, and equipment account for the subsidiary. But then we'll also debit the retained earnings for the parent company. The same principle that we looked at first on 80 and 100. Is it okay?
It's fine, very fine.
Mm-hmm. So let me just.